Hello, everyone. Let's get started. A lot of questions this week on Twitter. People are very concerned. Some of the young traders sending me questions and concern that they've been reading Market Wizards. I mean, I guess from the 90s, the original first or second book that where some of the famous traders are saying that they don't think trend following will continue to work unless we have lots and lots of inflation. So I think we've talked about that a lot. We can bring that subject up again. I don't think these were really hardcore trend followers, just people who proclaim that they use some trend or things like that. So we can start with that or talk about some other things. And of course, we have Derek's tweet and some of the ideas he was putting on Twitter about multiple entry systems and things like that. I got some other questions about can we hunt for outliers by trading indices? Of course, I don't trade indices, so I hunt for my stock outliers by trading individual markets. And I did listen to Richard's podcast with Niels, and I had some thoughts or questions about some of the things Richard said about trading currency pairs, non-US pairs, Aussie Canada, for instance. So let's see here. Derek's on ready to talk, so I'll let him make some comments and explanations and about some of the things he was tweeting about. Go ahead, Derek.
Sure. Thanks, Jerry. I guess I'll start with the general principle that what is convexity and why is it important. And I think that it's overlooked because it's something that CTAs create out of nothing. Normally, you need options or fixed income as in something with a curve, so like a bond curve or a yield curve, something like that to create it. But simply put, convexity is acceleration. So if you were thinking we're driving a car, the speedometer, it's at 55. That's your speed, and then the amount you press the gas with your foot, that rate of change, and the rate of change of the speedometer is the convexity or the acceleration of it. So the tweet I put out talks about how CTAs with multiple entries create this on their own, in fact, and don't need to pay the options premium to do that. And what I found is the best toy example. I put it on the tweet for those of you who maybe didn't follow, but like you can imagine you have three breakout systems, and you have a slow, a medium, and a fast. And your fast will trigger first. You'll put on 1/3 of your position. If and only if the market goes in your direction, are you going to put on additional exposure, and then you would get, say, the middle term breakout, and then finally following, if and only if it continues to go in your direction, you put on more. So you are scaling into the position only if it's going in your direction, and that's something that a call option has, that convexity. So you're getting more exposure as you're becoming more profitable, and you're trying to get more P&L out of that single move, because like you're accelerating into it, and it does tie into that aspect. Some further research that might be interesting around this that we have talked about the last few times is traditional trend followers versus multi-strategy CTAs. When multi-strategy CTAs add other strategies, particularly mean reversion, they pay in convexity, as in they lose those wigs. So I'll imagine another scenario. On the x-axis across, we have S&P 500 returns. So it's like plus 10%, minus 10%. A traditional CTA only trend follower, as the market crashes lower, they will get more returns. And maybe if the market stays towards the zero line, you might lose money. You're whipsawed around. The newfangled or multi-strategy CTAs will try to reduce that. They'll try to lift up the bottom part, but they won't catch the trends as much. So they're paying the convexity to reduce the amount of cost that they have from when there's no trends happening. I have more to say, but I'll leave it for there. So anyone can ask questions for what I said.
Good day to everyone. Hi to everyone. As always, very happy to be here. First of all, I want to thank Richard for a very interesting discussion with Niels. I was impressed by it. It's a very deep transform philosophy, deep opinions, and I was very glad to hear this. Very interesting. And I want to say about multiple strategies that I thought about this a lot, and I did a lot of research in this direction, and I had a lot of research mean reversion systems, and I did not found a good decision for that, because uh, all mean reversion system there, in fact, I don't see the robustness. I see some maybe level of robustness in mean reversion systems, but I don't see necessary level of robustness for me. And so, if we are trading trend following system, if we see trend, we will see a profit. But in mean reversion system, in a flat period, we can see a drawdown, and after that, it will be a trend period, and it will be another drawdown. So I'm not a fan of combining classical trend following with something else. Maybe there are such decisions exists. I don't know, and I did not find it. I don't.
Hi Jerry, hi everyone. Thanks to be here. It's always a pleasure to talk to you guys. Derek, I love your point about convexity, and it got me thinking if we can implement trend following through options, how could that happen? And a different point is how thinking in terms of premium, as you just said, in a trend following system, we're not paying that premium. Well, that's not quite how I see it. I see we paying this premium on the array of small losses we take, but the advantage of a trend following instead of, I don't know, simply a ladder of calls or puts on the S&P, is that you profit from different market circumstances. It's not a perfect hedge against a drawdown in the S&P, for example. It's not a perfect hedge against a drawdown in any particular market, but it's definitely a robust portfolio against all market situations. At least that's how I see it. So just to wrap things up, how do you interpret these two issues? One is, could we implement trend following through options, and the second is this all market condition hedge.
I think that there are a lot of tools for diversification. Maybe correct me if I'm wrong, but I think that it's not necessary. I did a little research in this, and I think it's not necessary to include options in trend following space. I think it's not the best idea. There are a lot of market that we can include, and it will give us profit more definitely. I think more certainly.
Okay, I will address Bruno's question. Yes, someone named Dow wrote a paper in 2017 that attempted to replicate trend following and its convexity compared to the S&P, and the trend following index I believe that they used was the SocGen CTA index to show that overall CTAs do have this, and in economic terms, you're basically you have a long variance swap minus a short variance swap, and then that goes into the second point, um, which is what do you pay in premium? And okay, so to unconfuse everyone, we don't need to know what those variance swaps are, but short-term volatility versus the long-term volatility. And that's the important aspect here. And that's where you pay the premium with the futures. You pay in whipsaws, which is why people have tended to increase their ATR stops over time, or like you see a lot of people used to use 3 ATR, and now maybe you're using 7, 8, 9, 10 ATR. It's because of the quote noise that people are trying to get out of. And that string of small losses you have is in fact the premium. To think about it reverse, you can imagine that you bought a call option instead of a future that doesn't have a stop loss. You pay the premium, but you have no whipsaw risk because your stop is already set. And if it goes below your strike price or the at the money, if you bought the at the money, you would not be out of the position. You would, in fact, be able to ride out that short term volatility and wait for that long term volatility, which will create the outlier. So, in this strict sense of buying and selling these complex volatility positions or a sequence of straddles to replicate, it is possible.
Hi, everybody, and thanks for that discussion, Derek. Look, my question about options is that there's a lot of aspects of pricing that go into options, and interest rate, volatility, time to expiry. These sort of all influence that premium price. So the way I see trend following is I see it as a much more simple, pure method. And I worry that all of these complexities and also the necessary forecasting that goes into this volatility measure of options, because that's implied volatility, which is inherently a forecasting or a predictive method. It's not historic volatility, it's an implied volatility. And I often wonder whether it's just confusing the issue and actually diluting the long-term returns pound for pound against a well-diversified, systematic trend-following strategy. I wonder if there are actually more inherent costs that lie within an option replicator of what trend following does than just the application of pure trend following. Have you done any research, Derek, on sort of pound for pound comparing the efficacy of both approaches?
Yes, I have, and I had tried to replicate a breakout strategy with options. So instead of buying the future or whatever underlying, to buy an option instead. And Richard, you did hit the nail on the head. If you just buy a pure option, you are exposing yourself to risk that you're potentially not being paid for. And the whole point of what we do in this business is you only take risk if you're going to be paid for it. And we are taking the futures risk in the delta one to potentially catch a trend, and we know where our stop is. And I think that that's kind of where the magic of this whole multi-entry thing comes in. The more systems you have and the smoother you are to get into a position that's going in your direction, the closer you're able to get the kind of acceleration an option would give you without the extra implied volatility or any of the other Greeks that you don't want. But the downside is that most of the time you're not accelerating out of them. It's not symmetrical. So you can imagine you get into 3 breakout strategies. Mostly we talk about breakout strategies here, so I'll just use that. You get 3 in, but say you've hit all 3 in, and then you get a pullback. You're eating the full loss of that negative move on your maximum exposure. While in risk-adjusted terms, the option would have done better because it would be reducing that loss as it came down and lost its delta. A way you could, that I have been doing this, is actually you can use continuous signals. The more continuous you get, the closer you get to having the option without the extra optionness. For me in my day job, we do use options to augment a small part of the portfolio because it does give us that short-term pop and that acceleration out of that like very small zone where the futures may not be kicking in yet. But a majority of it still does come from the futures, and you can use the multiple systems going basically to infinity to get a replication of that. Uh, the issue is just the downside reduction of that exposure when it's going against you that you're not getting, if that makes sense.
Many thanks for that, Derek. There, that does make sense. Look, I was thinking that the use of options is an inherently wise move for fund managers that make the initial mistake of not adopting trend following. So, in other words, when we have a fund manager who has invested in all of these products that are inherently all long GDP assets without them necessarily realizing it, then that's where you come in with an options play with a tail risk strategy that is perfectly structured to actually provide that tail risk with the prerequisite requirement of paying the necessary insurance premium, etc., to guarantee that tail risk. Now, the trend following funds, or our diversified systematic trend following funds, do not necessarily offer this crisis alpha protection, as we've all discussed before. They are inherently uncorrelated against buy and hold programs of equities, but there is no guarantee that this crisis alpha will eventuate. But we certainly have seen in the past with all of the studies that when we do get into these protracted crisis periods, yes, trend following does offer crisis alpha, but in those times where we get these quick whipsaws in and out, that is not a guarantee. But certainly within options, when you apply that to what I regard as sort of inferior absolute return methods, you can structure an arrangement using options to guarantee that crisis alpha. But is that how you see it as well?
No. I do believe that you're right that people are trading a lot of short volatility strategies and they don't know it. Like everyone who's trading fixed income doesn't actually know that they're short volatility and selling the volatility to an equity holder. But the way I see it is I am making trend following do what it does faster. And and I'm able to hold on to through these whipsaw positions. So I'm diversifying away this whipsaw risk. And let me clarify both of those. So let's imagine I want to accelerate out of this thing. So we know that you have a U, right? This U is the convexity of your returns. Up and down is your P&L, and left and right is the movement in the underlying. So as it goes farther away, these returns are larger and larger. The multi-strategy funds have a very wide, like almost flat convexity now because they've added those mean reversion strategies. A trend follower will have slightly more of a U shape. Because you're taking the pure trend, you're able to accelerate out of it. You've got your multiple systems and you're putting it on. And if it's a big return out, you're going to probably make more accelerating out of it than just the 10% move it moved either up or down. What I'm doing is I'm actually turning it into a V. So you get that swift acceleration out, and as things kind of move very sharply, or that's something that helps. And then on the other side of that, it doesn't necessarily give the crisis alpha part. More, I see it as an extension of trying to get rid of the risk I'm not necessarily getting paid for. I won't say I'm specifically targeting this because whipsaws have increased over time. That's not what I'm saying. But I'm saying it is something that all of these trend following systems, all these breakout systems are susceptible to. And if I can hold a little bit of that position, it whipsaws against me and then goes back and re-triggers and I re-enter. I'm now in a much more profitable position than I was if I got stopped out all the way on some risk that could have been diversified and then have to reload again, if that makes sense.
But Derek,
Yep, thanks very much.
one question here. What you intend to do is implement trend following through options, or treat options as a different market class, and put them on your breakout systems, for example.
I augment my trend following with options, and it's still something very new for us. So, and it's a very small portion of the risk we put on. But
Okay, so that's an independent system you're overlaying everything with.
it's an overlay, yes. So we take all of
Get it.
the systems, and then we might put a small fraction of that total risk. So, like, say you're risking 30 bips, I can put 2 bips or 5 bips in the options, and the rest ride as normal, if that makes sense.
In Kaminsky and Grazerman's book, Trend Following with Managed Futures, they have a section on straddles, essentially selling a put and selling a call, where they talk about the kind of the dynamic leveraging that you can occur, and how you can improve your Sharpe ratio, which I know is not something that we're fond of. But particularly when the VIX is greater than 20, you can really enhance your returns. But anyway, I just wanted to say that on it starts on about 197 on that book, where they specifically address selling the straddles to enhance your profile returns on that. So that was all I wanted to add.
Derek, thanks very much for your very interesting idea. In toying around with it, I sort of find myself being bounced back, or being sort of, fought back by the implied versus realized vol premium. Meaning, most of the times when you buy options, you end up paying away that premium. So, unless there's something in your signaling that actually has more forecasting value, that says, okay, now is a good time to sort of, buy extra convexity and paying a little bit for it, rather than just purely trying to generate it through trend following and delta one instruments. My tests, and probably have not been good enough at finding the value, but my tests have been that it's really difficult to time that sort of overlay. So, how have you managed to make it work, basically, without obviously giving away the trade secrets?
Sure. The key is in the exit, to be honest. You can't take it to expiry. You have to manage it, and you do it the same way you would manage any
Right.
trend.
So are you saying that, sorry to interject, but
Go ahead.
if I lose half of my premium, I'm out? That's effectively my stop on the option, something like
No. What I'm saying is that option is just going to sit there and go with the trend as long as you have the signal. But the additional edge comes from managing I hate to say managing the winner, but like, because options don't move linearly, your trailing stop on an option cannot move linearly. Does that make sense? So when you start to lock in the big winners,
100%,
and
yes.
options can pop, 1x, 2x, 3x, something like that.
Yeah, it's
Then
a turbocharged trend follower, as you said.
yeah, so you need to lock in at also an exponential rate. You can't. It's the same theory in effect of a trailing stop, but you have to lock in at a different speed because it's moving at different speeds, if that makes sense.
And I think it's roughly 25 to 30% of the premium collected if you're selling the option.
Okay, so what you guys are saying is that the winners are going to move faster than the losers, so it doesn't matter which one you pick. Diversification again comes to your rescue, and so that's how you get the extra convexity, quote unquote.
I wouldn't say it's free, no, but I would say in my research, it's been worth it.
Yeah, that's why I put in the quotes. Yeah, it's never
Yeah,
free, but I
yeah,
understand for much
it's not
cheaper.
free. Yeah, it's much cheaper because, okay, this goes back to like what I said before, which a lot of people disagree with, the prediction. If you believe that after we have our trend following opening, the possibility of drawing from a non-normal distribution, or even more fat-tailed than what people think are the fat-tailed distributions, then it becomes worth it, because even you pay that price, it would be mispriced if you're thinking about it in pricing terms, right?
Yeah, absolutely.
So you've changed your expected distribution today because the options are pricing the thing today. And if you believe that even that tail is 1 or 2% fatter, that makes that option significantly cheaper, right?
Yep,
Yeah, you're paying for
completely.
a 2% sale, but it's actually worth 10%. That's what you're saying, right?
Well, the prediction
I think
is
what Derek is
incorrect
saying is
against
the
the
decay you
actuality.
get. Sorry, Richard. The decay that you pay in all your options is sort of paid for, or almost fully paid for, by the exponential moves you have on, 1 or 2 or whatever, a minority of fast moving positions. And so that's how you create extra convexity in your portfolio. Is that right?
Yes. And the active management part is important. Probably the most important thing I can put out there. It's more important than trying to figure out a new version of Black-Scholes or any new pricing model you can think of. Because trust me, I've tried, and I'm too stupid to come up with a one. But if you do that and you do it for a reason. I'm not saying like everyone go out do this. This is not financial advice. My compliance has already been up my behind on doing tweets and stuff. But it's an interesting idea that I think accentuates what trend followers are already doing.
So, Derek, that we could actually achieve that by using more short-term models in our diversified portfolio, because what we're talking about here is the gains achieved through this non-linearity. You're achieving it with your options method within the short-term space to get this big, quick kick. But I'd say we could probably also achieve that with our short-term models in a more diversified system suite that we apply to trend following. Would you say that's the same?
Not necessarily, no. I'm putting gas on your outliers, Richard. When those outliers occur, which will happen when we're in our breakout signals, that acceleration is multiplied by the acceleration of the option. And you can replicate it very closely if you do something what Robert Carver does, where he has continuous signal scores.
Okay, so you're looking at the inherent
Increasing and
leverage in the option itself over a classic futures trend following model.
Sorry, I
was just saying you're looking at the benefit that options gives you in the extra leverage it gives you with the actual nature of the model itself versus, say, a futures model.
Yes, and specifically following the trend following kind of mantra of hold your winners and maybe even get bigger as your winners, because the option that, like, we're only buying options here, we're not selling any options. Like, if you buy an option, it's naturally going to accelerate into your winner. It's going to get bigger as the price goes in your favor, and if it goes against you, it's going to shrink down and get smaller. And that is something that we like to do. We want to control our losses. We want the minimum position size on when we're taking a loser, and we want the maximum position size on when we're taking a winner. So if I just flip the script on that, and we already have all these other kind of pieces of this complex adaptive system, we're hunting tails and all that. If that's the case, maybe I'm being a young aggressive guy, but putting some juice on that, something that multiplies that acceleration for potentially different costs than what you see could be interesting.
So Derek, tell me if I've got this right. Suppose we have a trend following system, simple breakout system with entries and exits, and we have a full system composed of, I don't know, 5 subsystems. One enters on the 20-day breakout, the other is 50, the other is, well, just to make things easier, they go 10 by 10, 20, 30, 40, 50. and finally 60-day breakout. On a particular market, a move can be so strong as to hit all these breakouts, and you start your position on that 20-day breakout, and it goes, it scales up, and by the end you have a 5 times leverage position. So this way you get this this convexity we were talking about. As the price moves up, your profit goes up on a more accelerated rate because you're increasing your position as the price increases. What you're saying is, oh, and all these systems have their problems. We are accustomed with. They all have their drawdowns. They all have their costs in a general speaking way, and that's why we find it safe to put only 5 subsystems on our whole complete portfolio. Fine. What you're saying is, through these option strategies, you can
Juice it up.
I'm forgetting the word. Yeah, juice it up. Thanks, Richard. Sometimes my English fails me. You can juice it up and accelerate even more this convexity. Is that correct?
Yes and no, and I will say there's a risk management component to it there as well. Let's imagine something is at the all-time highs. Bitcoin is at all-time highs. You have 5 systems. All the breakouts are going to be at the all-time high. You're going to enter maximum position at that time. You don't have any convexity. You're all in and all out at one point. So that's a period where you won't have that benefit. It's only when the entries are staggered. So like if they all trigger in one day, as your example, you also don't get the convexity. But it's also risk mitigation in the fact that, say the next day it's a down day, you will take that full down day's worth of loss when you've reached your maximum position. If you have option position, you won't take that quote full day's loss. You'll still have some premium left, some time left, and the delta of that option will shrink as the position goes against you, which means it's getting smaller and smaller. It's reducing itself in relation to your P&L, which is something your futures cannot do unless you're continuously removing exposure along the way.
Derek, do you use implied volatility to determine whether or not you should buy the option versus sell the option if you're looking for a directional play?
Structuring is important, yes. To be fair, in 99% of the benefit, okay, maybe I'm exaggerating, but like we'll call it 80% of the benefit can be done through continuous signal replication. The shrinking part, but it increases your transaction cost, which then becomes like, is that going to augment my capital? I mean, the premium I'm putting up for the option. However, if you are already doing that, or maybe you don't have the ability to continuously manage the signals to reduce that downside, then potentially yes. And the reason I gave the example before of the double variance swap, buy the long, sell the short, is because of the issue of the option is exposing you to other stuff. Now, I'm not saying anyone go out to an IB and try to get an ISDA and get these swaps. No. But what I'm saying is you're diversifying away a specific risk we know, and you're taking other risks that you might not be getting paid for. The question whether or not your system or systems are able to overcome that. And if we do believe that we are able to catch outliers, then actually, in fact, if the outlier does come, the IB will spike up. But yes, I am taking into account implied volatility.
Derek, hi, it's Niels here. I mean, your example may be absolutely right, but I have a question about it, because the Bitcoin example you gave before, where you say if it's at an all-time high and it triggers all the breakouts on the same day, and the market then trades against you, then you take the full loss, so to speak, if you're just using futures, but you're not doing that with options. But the same would also be the case if the market continues up, then you get the full benefit from the futures, but you don't get the full benefit from the option because the delta is not 1. So I can kind of see it both ways, right? That there can be some benefits to it, but there can also be benefits from just using traditional kind of futures breakouts.
Hello, Niels. 100% agree with that. It's because we add path dependency. We don't know how it's going to go. Sometimes the pure futures play would be more profitable. Sometimes the options play will save you some money. All I'm saying is that you can do this. I do this. I find that the benefit does outweigh the risk. It is very much more complicated, but because we know we don't know, and we know we have a very specific risk, I call it whipsaw risk, but I know we can call it something else, or the specific risk where you're all in at one moment, and that can be taken out of the equation, and we become less dependent on the next 10 days being up for our outlier to come all at once, which is probably very improbable. Then why not do that? We become much robust in our execution of the strategy rather than because that's what we're trying to do anyway. We're trying to split up our systems, our time frames, how we execute. We're trying to find the most robust way, but we're still susceptible to this path dependency issue. And so you do give up some of that upside because of delta 1 versus a 0.5 delta, yes. But is it worth it? Is, I guess, the...
Yeah, but
I was just gonna. Oh, sorry.
No, go on, Jeffrey.
I was just gonna ask, like, so do you see again? So this almost sounds like another diversification opponent. So another way to diversify your models, and spread out, picking up the outliers. Or am I looking at it wrong?
That is correct. I'm not trying to break any of the axioms of trend following. I'm just looking at executing it a different way because I see a particular risk that no matter how many breakout models you have, they all share one risk component. And if I can get rid of that, but still maintain the mantra of catching the outliers.
Yeah, the thing is, after a point, you lose the convexity on the breakout models. Just like you said, if you're hitting an all-time high, if supposedly all your models are hit, that breakout is hit on the all-time high, your convexity is none. You have a linear profile of return, and you're full risk with this linear profile. What's far from good. If I get this right, you're saying that with this through options, you can have a convexity all the way through the price movement, right?
No. You won't have it through the price movement because the convexity decays as you get farther and farther away from your strike. But in your example, if you bought all of your all of your futures at one point, and you just bought a single option, you would have a position that's all of your breakouts at once with no convexity because they all triggered at once. And you even purchased one option. Now you've added back convexity component that would have been impossible to achieve through the pure futures. Or if you're in the continuous signal space, when, okay, like we use Robert Carver's book, like I think what is it, plus 10 or 20 or something, there's some number where he's like, this is the ceiling, and that is the maximum position he will take. Once you reach that barrier, there's some barrier, whatever it is, whether that's 10 models in a row or you do a continuous signal, you're able to add additional convexity. And that's maybe why I said you add fuel to the fire, which maybe wasn't the best analogy.
This thing you mentioned, Bruno, where you're all in on all your models, that's certainly something I don't achieve with mine, because if you get this system diversification where a component of your systems are breakout models, a component of your systems are different, various different trend following models, you get this diversification of entry, you get this diversification of trailing stop, diversification of initial stop, so you get that convexity in a staggered way as each of these different systems get triggered along the course of an outlier. So there isn't a point in time where suddenly it goes linear on you because all your systems are triggered, because say we have 10 different systems, it's going to take a supreme outlier to ever be in that position where all 10 systems are activated under a diversified suite of trend following models. So this is sort of bringing the argument back to why pyramiding is perhaps a bad thing, because it invests all of your system models into one form of outlier, or the path dependency of a particular outlier, the particular trajectory. But with a diversified suite of trend following models, you're looking at attacking an outlier of many different possible paths and catching segments of that outlier as it progresses.
Yeah, but you need lots of capital to deploy lots of systems. I'm wondering if this options mechanism is a way to achieve this diversification of systems, or the benefit of diversification of systems through a possible way with limited capital. But yeah, you're absolutely right. In the limit, it should be a very rare case where everything's hit at once and you're fully linear.
Yeah, the problem, I don't face that problem, say, with the instruments I trade, because I'm trading CFDs as opposed to futures. But that's one of the limitations of futures I find with small capital accounts. You cannot get that underlying leverage. So Derek's talking about options as a way to get this extra juice with leverage applied through applying that particular instrument in it. And I'm saying, well, there are certain derivative classes such as CFDs where you get this inherent leverage in a CFD. So why not use a CFD as opposed to, say, a futures instrument? Because I can get 10 systems deploying 0.1% trade risk on each system, so a total exposure of 1% trade risk if they're all active at the same time, which they never are. So, and I can achieve that on a very small capital account.
Derek, thanks very much for the explanation before. I think that makes sense, and I can see why you're saying that what Rob is doing and his methodology with continuous signals kind of gets close to that. I think my thoughts are that I kind of agree with Richard that diversification of systems, not just look back period, but actually different types of trend following models, can go a long way combined with obviously diversification across look back periods for these systems. And then the other thing I would say is that without knowing the details of how you do it, I think certainly you have to really consider the complexity of the two processes. And also, if you're going to use options, I would imagine that the universe of markets you could trade would be much, much smaller than what we can do in the futures markets, and not incurring, too much slippage and trading costs, et cetera. So overall, would I rather have a diversified trend following portfolio with 50 or 100 different markets, maybe as Richard suggests, with even different types of trend following models, compared with, and I'm assuming here that your methodology might mean that you would have fewer markets, but then you would also do it slightly differently. And I think sometimes, and I note that Gary is very quiet so far today.
I do too.
Because I think what it comes down to for me is just simplicity. And I think we can end up doing things that are so complex and we introduce so many moving parts that we kind of lose sight of where we're going. And also, let's not forget, we are introducing other risk factors. As soon as we enter the options market, there are other factors we that you've already addressed. So I think it's interesting, for sure. But I think for most people, I think traditional trend following using futures is probably where I would put my money.
I don't want to words in Derek's mouth, but I think it's very clear once you understand that his strategies hinges on continuous signals. It means exactly as you said, Niels, that you do give a bit of credence to the fact that signals themselves have predicted power, meaning a stronger signal has is a an indicator of a more likely trend. So you turbocharge that with options, and that's how you get to pay for all the mediocre trades in all the other positions where time decay sort of takes away the premium. Is that correct, Derek?
Yes, I will address both. Bruno is correct. It's the same principle of you have small losers, but when you have a winner, they're very, very large. And because of the implicit leverage and the convexity of options, 5 baggers, 10 baggers are definitely in the realm of possibility. And I do feel like that does follow the idea of trend following, but 100% Niels, it is much more complicated, and it's only a marginal benefit. I it, maybe I'm still in that part where it's like Moritz mentioned in the podcast where he's like, I wish I just got simpler earlier, you
Peak,
know.
peak complexity, Derek. That's where you're heading.
Yeah, peak complexity. Um, and I see things that I want to accentuate in trend following, and maybe I'm trying to throw my own flair on it, potentially misguided, and that's why I think having this chat with you guys, not only be able to express my ideas, um, but also to talk to such veteran people, because I think that for clients and what trend following does, the convexity compared to the S&P, we are the alternative sleeve. We always will be. We need to provide convexity to their portfolio because most of them have short volatility or you know like negatively convex payouts, whether it's because their exposure to their business, the GDP, fixed income, however. And so, how can we deliver that better was where this spawned out of. But the universe for the options is significantly smaller than the rest of the options. I mean, rest of the futures we trade that without options. So we trade the full suite of futures that we have access to, and then those that do have options, we try to allocate to that as well to diversify the risk where we can. Which is why I said earlier, maybe you get 90% of the performance or not even 99% of the performance out of the futures is because the universe is limited. And, for most people who are not doing this on the day to day, maybe that little bit extra is just not worth it. It's better to, well, at least for us here in Singapore, go to the beach and have a swim in the sea instead. But I like digging in, and I think that's kind of a problem when you reach peak complexity, or it's like you don't know how to better yourself and how to better the system. Maybe it's already better, and then like how do you make it is simpler, and then what are you trying to do? And I don't know. That's kind of gone off the deep end of the philosophy of being a trend follower. But I think that's my answer.
I hope.
Derek, have you looked at Derek just out of curiosity? Because I think I think I know what you're trying to achieve, which makes a lot of sense. But have you using options, just thinking of how could I potentially have a dynamic position sizing? Doesn't mean that you have to have necessarily more signals, but you could size your position differently depending on certain conditions. Again, don't want to introduce too much complexity here, but I wonder whether having the full suite of futures, but maybe having a different way of thinking about the position sizing might give you, in a less complex way, what you're trying to achieve with the options.
Yeah, I mean, the continuous signal or lots of signals, like Richard was saying, where you diversify across and you have multiple signals triggering. I mean, it could be um, uh, as long as they're all slightly different and they're coming together and you're accumulating or decumulating. I don't know if that's a word. Decumulating your position in relation to the strength of the trend or however is part of it. But the specific aspect of position sizing, I still do the classic ATR method.
Sure, but what I'm thinking here, just say, okay, we take the same size risk every time we get a new signal, but that's actually not what I do in my trend following model. There are variable position sizing depending on certain things, right? So all I'm just saying is that maybe there is a way, maybe there's something you can detect in at certain times when you get these breakouts. And I'm not saying that the strength is better or whatever, but it could be whatever you find might work, and therefore you don't necessarily just take the standard X, percent risk. Sometimes you actually allow your model to take more, and if it pays off, then that's another way to get to achieve what you're trying to achieve. Just thinking out loud here.
Oh, Niels, you've tempted me with a crumb. I am going to follow that on Monday now.
I'm a bit worried we've given Jerry too much Bordeaux, and I'm hoping we can raise him from the dead.
Well, I've been feverishly writing down my questions and comments, and I have a lot. So, and I don't think I'll ever. It's too late for me to understand the options. Although I think in a previous meeting I did mention that I had over the years sought out option experts. Unfortunately, I didn't know Derek because it sounds like good stuff. I think I do have a couple of questions though. I don't understand, and this could be just a brief explanation from Richard as to. I wrote down CFDs are greater than futures. I've traded CFDs many years ago to get stock exposure,
No, they're not
but I
greater,
don't.
Jerry. They're definitely not greater. They're just something with a small capital account gives me wide diversification, but there's too many costs backed into those CFDs that you get a far better bang for buck with futures. It's just something that's applicable in my very small retail world.
Is it because the CFDs offer increased leverage, less margin?
CFDs inherently, because they're made by market makers, they're inherently loaded with additional costs that are beyond what you'd pay in your futures space. But because I'm going for this non-linearity in my trends and using very sort of long-term models in general, the impact of those costs in relation to that non-linearity is small, but there is a greater loading in CFD. So when you get down into the smaller time frames, you really pay the price, and it's a less efficient model trading CFDs than say futures. But it's certainly something, with a $50,000 account or $100,000 account, you can achieve very wide diversification, far more than what you can achieve in the futures space. We can trade down to micro lots of 0.01 lot, so we can get very extensive diversification, but there is that additional frictional drag of those higher loaded costs that when markets aren't trending, you do get these more exacerbated drawdowns. It's a bit more volatile, but you certainly get the non-linear effects with the leverage, because you get very good leverage in CFDs. So it's a sort of compromise I've had to stick with because I'm not as wealthy as Mr. Jerry Parker.
That's funny. Okay, thank you. And if just for the group, if someone could define exactly what is meant by continuous signal. Rob Carver, I'm going to go get his book now. Or pick it up and read it, because I remember probably him saying something about a continuous signal, but I don't know exactly what is meant by continuous signal versus a breakout. Breakout, system one breakout occurs and system two breakout occurs later, or one and two, system one and system two breakouts occur on the same day. Okay, you know how I would handle those situations. How does one handle and calculate a continuous signal contrasted between a breakout signal?
It's actually quite easy. You take a measure of a signal, so it could be a moving average or a breakout in terms of price points, and then you transpose that onto a common scale. something that makes sense to you. So some people normalize signals by price, by volatility, by something else. So you have to transpose your signal in away from a binary, from a switch on, off, long, short, into long, a bit more long, very long, short, a bit more short, very short, and that's a quantitative measure. So you can have a signal of 0.274, a signals of 0.25, depending on your scale. So you know how things are, as opposed to the more traditional way of saying, okay, today a breakout happened, I'm going to go long or I'm going to go short.
So is that like normalizing, well, not normalizing actually, you make it almost universal, whereby you can then use that in the option space?
Yeah, you have to harmonize all the signals across the different instruments. I mean, it's a little bit of work in terms of managing all these databases, but it's not complicated. You can normalize by price, you can normalize by volatility, you can normalize by whatever you want. But yes, a continuous signal is a distance, and then a difference, and then divided by some sort of something. And I don't want to sound very complicated or very esoteric. It's simple. In moving average space, you probably have two moving averages. You take the difference, and then you divide by some sort of something. Volatility seems to be a good idea. Some people use price, so you would have a percentage, and then you need to, if you worked in price space, and then that percentage would become a continuous, because it's percent is a continuous value, and so that's what the continuous signal is, and that's why Derek's strategy is interesting, because you're sort of saying, okay, my signals are getting a bit more long, a bit more short, and so you get the convexity. And to address your point, Niels, about that, it's not so much that I think Derek's makes money not so much when things are really really maxing out, but at the beginning when gamma is explosive and towards the expiry of those options. So I think is buying gamma for cheap, I think, if I understood it correctly.
Yeah, I see things a different way. Let me try to put the way I see it. We are all normalizing signals through our measure of volatility. That's the ATR. I think when I think about continuous signal, it's not about normalizing, but actually about seeing time in a continuous way. So suppose we have a system that looks to the 20-day breakout and another that looks to the 50-day breakout. Well, sometimes the 40-day breakout would be hit. Wouldn't it be nice if we have the 40-day breakout too in our system? All right, then we get the 40-day breakout. But then we can divide this time interval in infinite pieces. And that's the way I see this continuous signal. Is if it is as if the 20-day breakout is hit, and then the 20-day plus nothing, plus a very small number is hit, then we add a different position, and then two times this very small number, and all the way through the 50-day, but in a continuous fashion.
And that would be basically what I think Bruno was saying, is more long, even longer, and that kind of.
Yeah, exactly. At each piece of time that a breakout is hit, you're increasing your position, but in a continuous way. It's not one lot in the 20-day and then the second lot on the 50-day, but actually in a smooth way all the way through from the 20 to the 50, or whatever interval you want to look.
The way I would describe it, and it goes a little bit along what Bruno says, is that essentially you can create continuous signal using breakout. You just need a hell of a lot of them. So it's really just a matter of the number of steps you take in order to get to your signal. And also I would say about, of course, a continuous signal could theoretically be flat. While a breakout, if you only have a few breakouts, there's a higher probability of you being flat for a while if the market is stuck in a range. So there are small nuances in that. I think if you use fewer breakout systems, it'll definitely behave differently from a continuous model. But if you had a lot of breakout systems, you could almost think about it as a continuous signal, but maybe with a little bit fewer steps.
Yeah, in practice it would be the same because the contracts themselves have not continuous size, so you can't buy 0.000 nothing of treasury. I don't know.
Is the sort of bottom line for the trader with the continuous signal to guarantee that the signals are always spread out, and you don't all get bunched up like a breakout?
Yeah, exactly.
Okay, so now here comes so totally confused, even, but this is great. This is something I truly do not understand. I'm going to switch all of this conversation back to the futures, and I'm going to ask that I wrote down a couple of things. One is I wrote down that having one entry does not equal convexity. You have no convexity with one entry. So I thought all of our systems, our trend following systems, let's say we trade one. Some of us might trade one system. It's a great system. It makes lots of money. It captures all the outliers, but it's not. It has no convexity because it has one entry. And then I remember reading something on Twitter recently. I don't know if it came from Derek, but it said that we have convexity because we have a trailing stop. Okay, well, this one system has a trailing stop. All 3 or 4 of my systems that had to buy the breakout in Bitcoin at the very high, individually, they all have a trailing stop. Don't they all have this convexity? But somehow if I trade them all and they all have to get in at the same price on this breakout, then I lose all my convexity. What do you think?
Okay, it was totally me, by the way, Jerry, and you are right. You don't lose all of the convexity. You have the convexity of the future that you're trading. So let's put this in example. I think that equity indices are something we all can relate to. And they move down faster than they move up. That would be convex on one side or the other. And if you are short an equity index or a stock and it crashes down, you will have exactly that extra acceleration that it has on the downside on a single breakout than you would on multiple breakouts. But in my mind, that's the future itself. We capture that, and that is something that we can see in different instruments. Over time, they have this kind of feature. With the multiple systems, we are creating an option-like ability, the ability to have this convexity without necessarily buying an option. And as Neil said, the more of these breakouts you have, or the more staggered systems you have, if you're slowly, getting in as the trend is going with you every day, you're getting pretty close to what it would be of the full option that's able to scale in with that. So no, you don't have zero. You have what the instrument you're trading contains within itself. And if we have an outlier, which are usually these big accelerated, maybe exponential moves, like Bitcoin, that definitely has convexity on the upside, and you're able to capture that through a single system.
Okay. I've done some back testing research over the years, and at one point we definitely got very obsessed with preventing our breakout systems from all signaling at the same time. So what we did was we forced them to space themselves out. Well, okay, so initially we did force them. So we said, system 2, look at system 1 and make sure there's a 1 ATR profit. And then system 3, look at system 2, make sure that before you get in make sure you have a 1 ATR profit in system 2. Now that will underperform in the back test because when you base the system 3 entry on what happened with system 2, you are not, the computer says no good because you are not being consistent. you're not always buying at the same place, and so that underperforms. So then we would just say, okay, let's have all the systems have the same breakout entry, but system 1 is the breakout, system 2 is the breakout plus 1 ATR, system 3 is that same breakout plus 2 ATRs, etc. That is pretty good, but it doesn't guarantee 100% due to gap ups, let's say, that you actually do space those things out. So you'll get a huge penalty in your research if you have inadvertently or on purpose put in there anything that is not a fixed rule that the computer handles every single time the same way. Yeah, comment on that.
Yes, sorry, Jerry. That research that you did is exactly the same as the research I've done on this principle called pyramiding. So with those breakout models, the S1, S2, S3, it sounds like effectively you're pyramiding along the same trajectory. And so that is actually concentrating risk towards a predisposed particular trajectory of that trend or that outlier. Now, the first position you take on that trajectory is always the optimal position. The additional positions you take on that trajectory after you've achieved 2 ATR. So what you're saying is that you're in profit land with your first entry. Now you can afford to take another position, then wait until that both are in profit again, then take another position. So what happens with that scenario? It's concentrating your risk. It's the same as I feel this continuous signal that Rob Carver's using. It's concentrating risk. And I would say, well, we're trend followers, we diversify our risk. Why are we now suddenly concentrating our risk? This is a bit like a volatility adjusting measure. It's where we're applying a greater bet size because we feel that the signal is more predictive in nature. So what I'd say is, well, let's get away from that principle, and rather than having a pyramiding sequential sequence of systems, and one of the problems with that, let's say you're on Moderna getting this magnificent trend, all three of your systems are now triggered because you've had significant growth in your ATR. As soon as that last position fails, you're out of everything. That's because you've concentrated your risk. What I'm saying is, when you get multiple systems being applied, they are configured all differently so that you're not concentrating your risk, you're diversifying your risk when you're in that outlier. So when it fails, you don't get all of your positions suddenly closing off at the same time. You only get one position being nailed and 9 of your other positions are still alive, or it might go down further. 8 are nailed. 2 are nailed, 8 are left. So, when you get these magnificent sort of accelerating linear exponential trends and they inevitably lose a bit of heat and they come back, you don't lose all of your positions. You're still alive on your very long-term models, which are all separately configured to target different aspects of that particular outlier. So that's where I think this discussion is sort of getting into this world of pyramiding, which I'd say as trend followers we want to avoid.
Well, I was not basing my new positions or my size of my positions or doing anything in any way based upon the profit in the prior SIS1 and SIS2 buys. So I'm just saying, if I only had one system, I'd risk 25 basis points per trade. Now that I have 4, I'm going to divide the 25 basis points by 4. I'm going to divvy it up between the 4 systems. So I'm not, and that's what I think is a really good definition. I've tried to encourage pyramiding. It's let's just call pyramiding that. For my money management scheme, I can't afford to take the trade until another open position shows some profit. I disagree with that totally, of course, and that's something we need to stay away from. But we just had this idea that, hey, we really dislike, 2012, I got crushed by selling the breakout in crude, heating oil, unleaded, multiple times at the same time, all 3 markets, all systems, and I would take these losses. But another thing I wanted to comment was that with the breakout systems and the stop losses, the ATR stop losses, one can do a lot of trades at the same time for all the different systems. With the Bitcoin buy at the highs, all of the breakout systems are going to get in at the same time. They're going to, if they have the same stop loss, they may all get out at the same time. And then in some of the trades that have been consolidating, the short, medium, and long-term breakouts, they tend to bunch up. The big, huge monster trend in Moderna, no. That's, they're going to look a lot different, those breakout exits, even though they're highly correlated. Performance-wise, they could have much different P&Ls on the Moderna trade if Moderna sells off now. But if it stays where it is now, consolidates for 6 months or a year, those two will bunch up, and I won't have any real diversification on those exits. I think it's a dilemma that I want this diversification. I want it in the markets, I want it in the systems, but I can't fine tune it, because if I start to fine tune too much and make sure I get great diversification for my entries and exits, I'm now harming the robustness of my systems, which need to have very few variables, entry, exit, stop loss rules, and I need to actually do them, irrespective of, darn, I wish I didn't have to do all of these trades at the same time in all of these different systems.
I'm sure that pyramiding is something that goes into the opposite direction than trend following, classical diversification, time frame diversification. Using time frame diversification, we will avoid risk, and it helps us to be in a good shape. And using pyramiding, I'm sure 100% will destroy the account. So it's very different things, and we must understand that.
I want to touch on what Jerry said and what Richard said. When Jerry gave the example that he's staggering his signals for the breakout at some distance, it's not on the P&L, but some distance away, whatever that is, that in effect is creating this positive plus convexity if the trend goes in your favor. And it can underperform, as you mentioned as well, because what Richard said about this pyramiding, if it's a super trend, you would want all of yours at the lowest price. If it's a bad trend and it would have stop loss, you would have wanted zero. I mean, and maybe if you just get your first trigger, the fastest one, and then it stop out. So the issue with the pyramiding analogy, I think, is that it's not symmetrical. Because you're also not getting out of the extra exposure you took, which a continuous signal would do, or an option would do. Now, going back to Jerry's point about the diversification of the entry part, and I think that that is very important, and I think that's what I struggle with on a daily basis, trying to figure out simple ways to get rid of that. And I don't know if all of them take the same stop distance or how we can diversify that away. But I completely understand that. Well, the impetus for me to do the options things was because of exactly that. I don't know what the future will hold, and I don't know when things can bunch up. It can bunch up. It becomes an excessive risk. And maybe only it happens every once in a while, or maybe the market just gets quiet all of a sudden and lots of things start to bunch up. How to simplify that aspect, even if you have a lot of breakout systems, gets really difficult because of the nature of looking at highs and lows. So maybe that's where Niels or Richard is able to take other trend following systems to augment that. I'm not really.
Yeah, look, I definitely am a strong believer of these differently configured systems. So in a suite of 10 systems, I will ensure that as a golden rule, there is a certain class of breakout systems. So that ensures that I'm always getting into the outlier. And actually, those breakouts tend to be my early initiating systems. but then my other systems might be using a myriad of different trend following entries to get this diversification of entry in a sort of a sequential manner as the outlier unfolds, and their sort of their trailing mechanisms and their initial stops are all differently configured. So what you find is that when you get these nonlinear surges, you start seeing this progressive triggering of more and more systems. And then when you get to the tail end of the trend and things start turning around, we all hate leaving large amounts of profit on the table when these things turn around. We can't bear it. But what I am finding is that my short-term breakout systems are actually firing in reverse to giving a bit of sort of hedging at that late stage of the trend. They're all trend following models, explicitly trend following models, all have these golden rules of cutting losses short, letting profits run, all have an initial stop, all have a trailing stop, all have minute position sizes. But the way they all work in tandem, even though I can't predict anything, because they're all separately configured, I'm getting a very vast array of different possible paths, and there is a bit of hedging going on, which is really sort of it's stopping me getting this significant deterioration of profits when things start going in the other direction, because I don't like losing too much money when that unrealized profit starts screaming down to the trailing stop.
Yeah, I think trying to listen to all you guys as much as possible and respect your proprietary information I'm getting. And so I don't ask all the rude questions that I might ask, as you know, Americans are great at rude questions. So that I'm just getting the impression that my systems are very similar as compared to your different 10 systems. And I remember Moritz describing his systems and the way he sets up his systems using, and I was just like horrified by some of that, because I was like, golly, I'd never do that. So I just am in love with the traditional breakouts more than maybe I should be. But maybe you could explain maybe the root problem here, which I still don't have. I don't think I still got my question, or I got my brain wrapped around exactly this idea of the amount of convexity that I'm losing if I'm putting on the trade at the same time. Maybe it's that I don't fully understand what convexity even means. And I just go back to the comment that Niels made, which I sort of obviously agree with simplicity, but I think this is a huge benefit, of the good, smart quants getting involved with trend following, because this is how they add things. And so to them, Niels, maybe this is just like easy stuff. This is not complex. This is, and then they're incorporating this great trend following strategy with some of these option ideas. I think it's just really good.
Well, I mean, one thing that came through my mind when Derek was talking about it, and as I said, I mean, Derek, for all I know, you may have found something that other people have missed, but I've never come across in all the interviews I've done about people talking about using options to implement trend following. And I'm just thinking there must be a reason for that, because a lot of the people we talk to are super smart, have lots of resources. So maybe they have also come to, or maybe they have come to the conclusion that we're not benefiting enough from making it more complex, and it kind of drives us back to where I guess Jerry and I and Morris and so on and so forth, we always end up that in the long run, keeping things super simple is really our best guarantee for it keeping to or maintaining its profitability in the long run, and that it doesn't break, etc., etc. So yeah, I mean, I think again, I'm a big proponent of simplicity, although obviously, in a sense, Jerry's systems and my system is different in some ways, but they're also incredibly similar in most ways. So yeah, no, I mean, and we see again, in the last 18 months, again, we see the simpler trend following models and simpler in a good way, just basically performing the best. If you can, so it's all about path. It's all about the path of these models, right? If you can, if volatility is not what you're concerned about, if drawdown is the real concern, which it probably is for most people, then I'm not sure that a simpler system is going to give you more drawdowns necessarily than a more complex one per se. It's just but a more complex one might give you less volatility, but then also you might lose something in the performance in the long run. So I think that's what we need to deal with. What are we most concerned about, the volatility or the drawdown, and take it from there.
I think that a
Also,
lot of
sorry.
Okay. I think that, as I have said before, nature has a lot of things in nature have a trend in nature, so we can use very different instruments. I said the analogy with a chart of the weather. It's even a chart of the weather looks like trend following chart, like classical chart of maybe Euro USD, but I think maybe, and we need a big amount of data, historical data for this research, big resources, that some things maybe are working better than other things. In general, no. In general, rule, maybe no, but I think there are some exceptions, and I don't know all these exceptions. For example, VIX. As I know, VIX is not prepared, is not used for trend following. It's not the best idea to do this. And about options, I have said that I had a little research, not much. I don't have a maybe certain opinion here. Derek said very interesting stuff, but I think it's for me personally, it's better to find another markets because it's too many markets. Maybe some emerging markets or something like this. I think so.
Jerry, can I ask you a question about the diversifying in multiple signals? Because I always thought that one of the reasons that people use multiple signals, and I used some signals, but not a lot, is because when they start having size problems and they get too big, they have no other choice than to get a lot of signals to get in and to get out without that much slippage, and hence being small was a huge advantage. Do you think that's something that it's valid to say, that if you are a guy who's managing its own money, or a small trader or a small fund, you have an advantage, and so you can use much simpler and less signal driven systems?
I definitely have always traded multiple systems, sometimes hundreds and sometimes two. And I think it's, for slippage and moving lots of AUM around, it's good. And then just for, having different P&Ls on these big trends. It's what everyone's been saying. Anything can happen. The systems that I trade, the breakouts, they vary in length, but they're correlated sometimes, but they can be vastly not correlated on a certain trade. I'm going to get out of the soybeans and the corn and the oil at different places, even though the systems are highly correlated, and it's going to make a big difference to my bottom line. What I don't understand is when I run the back test, all of these systems, they do well, they make about the same amount of money. But I don't understand how when I start combining them and treating them independently, system one doesn't know system two exists. It does its own thing. I'm implementing all these rules. I'm doing them whenever it happens, even if they're getting bunched up. I don't understand how trading them together as 4 or 10 independent systems has a negative impact on my convexity. So I'm back to my question of a few minutes ago. Then maybe I don't understand what convexity is.
I can help there, Jerry. So look, the way I see convexity is I use the term non-linearity when I'm referring to convexity. So fortunately, this discussion we've been having tonight is a discussion that really only divergent traders would be having. It's certainly not something that you'd find common in the discussion of convergent traders or mean reverting traders. The predictive methods that apply convergence and mean reversion, they're dealing with linear models that can be statistically defined. When we're talking about convexity, we're talking about non-linearity. So we're getting this convex profile of our equity curve, this acceleration in our equity curve. So it's the acceleration that's the important thing, in that it is much better than a linear representation. And in that example I did in the podcast with Niels last week, I gave that example of a string of linear sequences, and then you get this massive non-linear outlier that creates this convexity in the profile, this acceleration that is more than just a linear multiplication. This is a many orders of magnitude. It's a power law that's driving this non-linearity. So divergent traders, the reason why we have all forms of divergent traders, this is why Wayne Hemelson thinks very similar to us, but he trades in the option space. And this is this discussion we're having with Derek. He's flirting with a degree of options to complement his models. It's about getting this extra leverage to apply to this non-linearity. So you're getting this multiple sort of non-linear components coming together to give you this spectacular return profile, or driving these massive outlier events, which is not just a feature of the markets themselves. The markets, when we extract that edge from a single market, there will be a degree of non-linearity in the market data, but then we supplement them with models that aggressively compound that non-linearity with multiple systems or options plays. So there's sequential degree of additional systems are all sort of making more linear the non-linear signal that we're already attracting. And then on top of that, you've got this third layer of non-linearity, which accelerates the equity curve, which is this compounded effect, which on a path-dependent equity curve, where we're continually revisiting these new high watermarks, but we do have these periods of drawdowns, but we've got very high unrealized equity. We're meeting new high watermarks. It's an ideal equity path to compound. So we get this additional non-linear effect of compounding to add to all of this other non-linearity. So that's how I'm viewing convexity. It's creating this accelerated roadmap of our equity curve. But maybe Derek can add something here as well.
Oh, for sure. Great example, Richard. The key is acceleration. And if we think of a car or something like that, it's the same. The idea is that, and bang on about the convergent divergent, only divergent traders can think of positive convexity. All convergent traders have negative convexity, as in when things go wild, they blow up. And you will see negative convexity in almost every blow up. Long-term capital management was negative convex. Archegos, or even the housing bubble, because people were taking a lot of leverage, and so lots of little moves on these fixed income mortgages explode their P&L, even though they take very consistent returns most of the time, they explode. So the opposite of that is we want to accelerate into our trades that will make us money, and the reverse of that is we want to decelerate out of, we want to slow down, we want to reduce our exposure to anything that may be a loser or reduce our compounding effect. I hope that helps. And to Niels, what you said about no one talking about it on your podcast actually worried me from before you mentioned it, because I really respect everything that, I mean, this whole group says, and when I'm the odd duck, I mean, it is a bit.
So, yes, I think I finally figured it out, what I was missing, Richard. Thank you. I preoccupied with the trade stats and the P&L per trade. So you're essentially saying, pay attention to that equity curve. So I wasn't hearing equity curve until just now. So I understand that because I keep saying they make about the same amount of money, all of these systems, and the expectation per trade and the P&L on Moderna with the different systems, I'm not focusing in on the benefits of spreading it out, entries and exits on the equity curve. But I would say if you could just explain, you also brought up this idea of quote unquote compound effect. But given how you and I don't want to take advantage of this compounding, increasing our trade level as we're profiting from these outliers, you and I are saying no. We don't really want much of this compounding effect. Is that correct?
Look, there's a subtle thing going on here because too much compounding basically instills excessive leverage in the portfolio. So that's where you get the Mulvaney pogo stick happening. When you're regularly compounding, reinvesting profits back in on a regular basis, maybe even on a trade-by-trade basis, you can get this aggressive two-edged sword where you get these magnificent uplifts when things are going well, but you get these magnificent downlifts as well. So it creates this excessive volatility. So a slow compounding treatment produces this optimal path. And for instance, if I have a portfolio that is heavily diversified and I achieve a MAR ratio of, let's say, 0.4 for the MAR ratio with a fairly lightly compounded solution, what I find is that might produce, let's say, a 6% compound annual growth rate with a 25% drawdown over a 30-year period. Now, if, for instance, I compound frequently on that curve, I can lift my compound annual growth rate to, say, 10% or 11%, but I pay it with a commensurate increase in my drawdown exposure, and the drawdown is a non-linear feature in the equity curve. The compound annual growth rate, you can look at it sort of, if I double the position size or double the leverage, I double the compound annual growth rate, but not the same is applied strictly to the drawdown, because that is a singular drawdown in a singular location on your path, and you find there's not a linear relationship to the drawdown. So your MAR ratio, when you get this increased leverage, actually reduces. So you need this sweet spot to produce this best path to achieve greatest net wealth with the best risk-adjusted metrics over the long term. You don't want to be too hard, you don't want to be too light. There's sort of like a sweet spot, a Goldilocks zone, where infrequent compounding is the way to go, Jerry, exactly what you're saying. You do not want to be too aggressive in compounding treatment, because all that does is it means that you get this magnificent wealth story, but it's excessively volatile, and every time you get this downturn in your equity curve, it actually dilutes the compounded effect. So with our equity curves, we get this stepped equity curve every time we hit an outlier. Every positive beneficial step we get in our outlier actually brings forward the compounding effect. We get a better long-term compounding effect. But what we don't want to do is compromise that with excessive drawdowns, which dilute that compounding effect. And so there's that sweet spot there. I hope I've explained that.
Yes. And would you say that if we were to explain this idea we have that we're going to be hesitant, more hesitant than most to move up the trade level, then the comeback could be, well, have you seen in your research that if you're more hesitant to move up the trade level as you make money, in order to achieve a certain target rate of return, you just have to trade each trade a little bit larger. And then we would say, yes. So instead of, if I'm going to be hesitant to move up my trade level, then in order to make 15% a year, I'm going to have to risk 50 basis points rather than per trade versus 40 basis points per trade. And so we could be accused of, well, it's the same thing. But would you say that it's really not the same thing, and that it sounds similar, but in essence, it's superior risk management to not move the trade level up? It's not the same thing, and it is better to not move the trade level up as aggressively as some do. Some use today's AUM for each individual trade, but to trade a little bit larger. So you're consistently trading a little bit larger, in order to achieve your target return than you would if you were more aggressive moving it up. But there is a difference, and it's something that is not exactly the same.
Look, I agree with that. No, what I'd say is that I disagree with any forced manipulation with which has a sort of like a predictive quality to it. So what they're saying is, if I want to increase my returns to a particular target, immediately that's said to me, that says, they're predictive. What I do is I deliberately stray totally away from that. So rather than increase my position size, what I will be doing is increasing my diversification. So, there's many ways to achieve a better return, but I personally think we're less aggressive. We don't apply leverage into our portfolio unnecessarily, because really that's you can be lucky, you can be unlucky, and leverage will give you a slap around the face if it goes the wrong way, but give you a big bonanza the other. That's a luck statement. So I would say don't increase your position size. That obviously, if you want to increase your returns, go for bigger diversification, because you want to hunt more for these more outliers. And the nature of these liquid markets is that the more you diversify, the more you're going to latch onto them. So do that rather than increase your position size.
Can I ask you a question? If you are going trying to get more return by diversifying, but at the same time I guess you're reducing your risk per trade. I know that in the long term, being more diversified is better, but aren't you diminishing your return by the fact that you're adding more and thus reduce your R, so to speak?
No, look, this is one of the big arguments I have with people that think only in terms of diversification is giving you a correlation benefit. I think it's far more than that. And I'd say, a lot of people say, oh, there comes a point in time where you can be too diversified. And this is what we were talking about at Top Traders with Niels, this diversification statement. Now, the reality is that diversification only really occurs with models that are not really targeting these outliers. So the outlier, the benefit of this nonlinearity is so much supremely better than the benefit of a nice uncorrelated portfolio. We actually sacrifice a degree of this sort of smooth portfolio by virtue of the fact that we really want to target these outliers, these nonlinear events. 10 times order of magnitude, once you hit one of those outliers, 10 times, 20 times order of magnitude better than whatever you could achieve through your nicely correlated portfolio. So I'd say place less emphasis on this marginal benefit of diversification angle that most other methods do need, because they're not targeting these outliers. We specifically are targeting these outliers, and that's why I say diversification is never enough. Go for as much as you can. If you've got to make a decision to increase your position size, well, don't do that. That just increases leverage into an existing model that's targeting a defined number of return streams. What you want to do is increase your return streams to get broader diversification. That to me is the optimal move, rather than a predictive method that says, oh, we can double our returns by doubling our position size. Well, you just don't know. It could actually double your losses as well.
But yes, and this is a really good point. And I wanted to say that I think you believe this, and I believe this, because we don't respect the fact, we don't think it's much of a fact that the highly correlated markets, one of the 3 energy markets or 5 energy markets, even if they're highly correlated, one of them can have the outlier. So we're saying we appreciate the diversification, thank you very much, but it does not allow us to say, hey, if I just trade 1 or 2 from this sector, or from this energy sector or micro sector like the grains or the metals or the energy, I'm covered. No, you're not covered, because, for instance, I've seen heating oil double at least 2 or 3 times in my career, and crude just kind of sat there. Isn't that really what we're saying?
That's
is
exactly right.
Yes, we don't respect this eternal diversification that we're going to get, or lack of diversification in crude, heating oil, and unleaded. in platinum, silver, and gold. No, we see it, we understand it, that it may occur 90% of the time, that they're the same market virtually. But we're going to trade all of these markets because, quote, trading 2 or 3 from the sector is good enough. No, it's not good enough. It's good enough 90% of the time. Yeah, of course. Crude, heating oil, unleaded, they look very similar, but not in hunting the outlier. It's a different
That's exactly
name.
right, Jerry. Look, one of the big things is that we're already applying systematic methods to cut our losses short. We're already applying a small bet size. We're already applying initial stop. Then what we're saying is, well, why don't we now look for these uncorrelated return streams? Well, that's sort of like an additional measure that almost is not totally necessary, because our systems that we deploy, our trend following systems, already have these built-in risk mitigation measures in there. So because of that built-in risk mitigation measures, which is different to a buy and hold that has no such built-in risk mitigation methods, and that's why they get these adverse tail events. So these built-in risk mitigation methods means that we can be a bit more lax in trading fairly highly correlated markets, because it can be guaranteed that we cannot predict where or when an outlier will occur, and it might be specific to a particular market, or it might be across multiple markets. But if we're always cutting losses short, don't we get this massive convexity when we suddenly find that we've got beneficial outliers cascading across similar markets that are highly correlated? We want that. Otherwise we're just getting one of them as opposed to possibly 5 of them. So I think that you can go a bit too extreme with risk mitigation and miss out on the whole notion of catching these outliers, which I think is our central prerequisite for our method.
I think this go hand in hand with Richard reminds us all the time about divergent and convergent strategies. Most of finance industry is filled with convergent strategies talk. And for convergent strategies, you need diversification, because sometimes a price will go to zero, will go to the ground. And if you're diversified enough, your portfolio is not dominated by this movement. Well, for us, it's the other way around. We are divergent traders. We want this diversification because sometimes some price will go to the moon, and that's what we want to exploit. It's nothing about risk mitigation. It is for the people in the convergent world, not for us.
I was saying that it reminded me what you mentioned. I think Richard said that the stops are not only for risk mitigation, but to free up capital for the next outlier, right?
Exactly.
I'm sorry, but I think diversification it's certainly one of the most important topics, one of the most important things in trend following trading, like risk management, of course. For me, two main things: risk management and diversification across the different sectors and markets. But I think that if a person doesn't have a lot of money, he must be use especially much common sense in diversification to avoid high correlation markets. And if he has a lot of money, it's okay to trade maybe 300 markets, maybe 400 markets. It will not be such a problem. It will be maybe the same results or something like that. But if there is no such much money, it's important to choose the markets in the right way in a correlation.
And so given what was being said by Richard, I was just thinking that that's why I have such a negative reaction to looking at vol targeting and equity management. And that's why it takes me a while to understand, oh, you're talking about the equity curve, which I try not to care about, because if I'm going to care about that equity curve too much, I'm going to compromise my hunt and my ability to let that outlier go to the moon, go further than we've ever seen before, not have this predictive approach that, it's gone too far or it can't go any further. So I think that paying attention to the trades and the trade stats and handling all these trades in a consistent way, and pretty much trying to disregard as much as possible the equity curve and the volatility is very important and very different from not only convergent traders, but most CTAs who have sold clients on managing the equity curve. And basically the downside to that, and as I've said before, my back testing has shown an incredible consistency in the long-term trend following, at the same time incredible volatility and drawdowns. But it can almost sometimes make money almost every year and have a very high percentage of positive trailing 12 months compared to other strategies that do more to manage the ups and downs.
I like the words of Nils in one of the programs of Trend Unplugged, and he said that real consistency is consistency in following our rules and not consistency in profit.
Okay, it's perfectly okay to change topics. Anybody in the audience that wants to ask questions, totally different than what we've been talking about, go ahead, raise your hand. I did have one other thing going back to options. This is probably a dumb question, but I was going to wonder if Derek wanted to field this, and that is, given this delta change that you described when the market goes against us in the options, does that require maybe a larger option position versus the futures?
Not necessarily. I mean, it's how much of the percentage of the buffer that you want. Because the leverage is also different in the options because it's an option on a future, so you have additional leverage there. That aspect of it is just the ratio between those two. So that's not necessarily the case, no. And if you did reduce the delta of the futures position, you could imagine that, like, if a position went one ATR against you, you reduced a bit of your position, and then you two ATRs against you, you reduced a bit, which would turn a classic breakout into a continuous signal. So I think that's what I'm getting at. I'm not sure.
I got it. So last week we ended with me with Seth talking about crypto and crypto systems, and my comment that I don't believe in crypto systems versus systems that I would been back tested using all the data that I would happily use with crypto in all the markets. Does anybody want to comment on that, or do you have anything you want to say, Seth?
Yes, I want to say something about crypto markets. Of course, I understand that's one of the instruments, and I have said before what I think about this. I think it's a little bit more scary about crypto market because I'm not afraid what it was the past of this market. It really looks like other markets, but I'm afraid of a future of this market, and I'm afraid that it will be much different than future of maybe markets of a corn, for example. I'm afraid of surprises. Okay, but I want to say now another thing. And I tweeted. I had a tweet on my Twitter, and I often see that with my tweet. I often see the advertisement of crypto phones, profiles of Bitcoin experts and social networks, etc. I think that the only reason why such things exist are big movements in these instruments. The situation can be changed maybe even a few months, and in fact, it can be changed in every moment. And so much attention to crypto world, too much attention, I think. People look on a crypto like something exclusive, something that will bring fast a lot of money, but in fact. There was no such evidence in history that one instrument gave maybe in the long term, yes, of course, gold, maybe real estate, but there is no evidence that one instrument or group of instruments, like one sector, will consistently for decades bring a lot of money, a lot of performance. So I think too much attention in the wrong way to the crypto market.
Or color to my statement from last week. I would say that as far as system speeds and look back periods go, I think crypto fits in with all the other diversified markets that you would look at. But I think just in the recent trading history of crypto, if you just backtest it separately, it tests a little bit better on the shorter end of what traditionally works across all markets. So I'm not doing anything different in crypto that I would do in futures or in equities. Slanted a little bit towards the lower end of what has traditionally worked in a diversified set.
But I think that also relates to it being and I might be wrong, but it being a new market. Because what I remember from an interview I checked from Perry Kaufman, he mentioned that newer markets tend to trend more because they are more into price discovery because it's a new market. So I feel like that's also the reason why maybe at this point you might be seeing short-term working or shorter term working is a bit better. But I guess as the market evolves, then the longer term or it's going to shift slightly more to a mature market, which means the longer term or the not the norm, but um, it will line up with the rest of the markets. So I feel I have my take on it is also because of it being a new market. That's the reason why, but it being shifting to basically the what we're seeing with the other markets, which is a bit more longer term.
My
Because it's like the current narrative in crypto for a lot of people is like the hold on for your life, like hold on forever, never sell. And you would think that it would, if most people were actually doing that, the markets would look more like they'd have a similar pattern to, maybe the S&P 500 or something where there's a lot of passive money that just buys and holds. I think there's a lot to be said for the lack of institutional involvement right now, and you have a lot more maybe undisciplined market that kind of leads to the shorter term. There's no way to, I think, prove any markets, but it's an interesting way to think about it, I guess.
The way I think about it, and I think Seth mentioned that, is the crypto trading that I do is siloed by itself. It does trade traditional methodologies, I would say, our divergent style. I mean, that is the bread and butter. But the issue is it's something that's very new, and if you do try to trade long-term systems on it, you will just not have enough sample size. So if you use your whole system, as in your whole portfolio, and you say, okay, I have a very small sample size on Bitcoin, but I know that through all of these other markets, it should be fine. Then you can use that to kind of augment the sample size, and maybe you don't even need to back test Bitcoin to add it. My research regarding specifically crypto universe trend following, I do believe that the metabolism of the market is faster. You get a lot more, we'll call it full cycles, at a much faster rate than you would any other traditional asset. And you could also think about it being an emerging market. Shorter term systems work better in more emerging markets, older markets. You can go back to maybe the 90s or even late 80s in the traditional futures markets. And I think that it's going to progress. I think it matures, it will head up. But if you silo it up, you need to trade slightly faster to generate the amount of sample size that you need while still, kind of following the rules we all know and love.
I might raise a question if that would be in order. So going back to market wizards, a couple of the traders featured there, they argue that trend following is quote unquote dead or won't work until there is a hyperinflationary or deflationary period. And they also argue that there are just way too many professional traders in the market, and this is the 1980s, by the way, for trend following to work. And in order for trend following to work again, they argue that you need more retail and, so to speak, inexperienced traders. So given the market environment today, given the influx of retail traders during the corona outbreak, would you guys argue, given your decades of experience, would you guys argue that today is the perfect environment for us trend followers? Or would you disagree with the fundamental notion that you need inflation or so many retail traders in the market for trend following to work? Thank you.
I think that trend following is a waiting game, so we must not think in such a way that this environment is good and environment that will be tomorrow will be bad, and so we will stop trade for a while. I don't think so. We must be all time. We must be in the market. It's my opinion, and I don't like to think about the environment.
I would say it's hard to obviously predict, but if you look at the current state of if we just take out the trading in itself, and if you just look at the world, there's a lot of extra uncertainty that's coming in. And not trying to be political, but if you just look at Afghanistan, what's happening right now, that's just an added. And then you have COVID just now, and you have quite a few other things, such as this discussion of inflation. So I think that would indicate that there's more uncertainty, and with that, I believe that trend following in that sense is at the right place. Obviously, we cannot time when something can happen or will happen, but with it looks quite optimal in the sense of something happening that could create outliers in the market. From my
I think that uncertainty is one of the main qualities of the world during its whole history. And Mark Jabrzinski said very interesting things that when people face uncertainty, he was speaking about military forces. They must use rules, be very disciplined and use rules, and this will help. So trend following strategies are really perfect for such.
And I think that for, I wouldn't say any market, but I think for the majority of markets, the trends are created from people's expectations. I think the main driver for the crypto market right now is that people really do expect it to just keep going higher. And I think as long as there's, at least one more person with that expectation, you're going to have yourself one more buyer. Of course, I wouldn't say that that's sustainable, but I would say that that is the majority perspective.
By the way, Mark Jabrzinski said that people expectations change very fast.
Yes, absolutely.
One of the things I've noticed is that I used to be fairly good at predicting outcomes. And I remember when I used to go back to elections back in the 1990s and 2000, etc., I was fairly good at predicting things. But what's clear to me is that there's been this unprecedented central bank intervention in the markets, which has been attempting just to suppress the market's natural tendency to want to change. It doesn't want to equilibrate. That this has been deliberate intervention by central bank intervention in trying to stop this change from happening, or to slow down the market's desire to transition, because we fear this degree of change. But what I do note is that this degree of intervention that's occurred in the last 10 years, in the scheme of history, is a very small segment, and we can see that everything has been thrown into the market to stop it trying to change, want to transition. So, I think the trends are here. They've just been suppressed, and we've almost run out of our ability to suppress these markets any further. So there will come a time where we'll see this massive transition occurring as markets try to do what they do without this degree of intervention coming in. So I'm very bullish regarding trending opportunities.
So do I. I think that I have said before that there are rules of nature, rules of world, rules of psychology, a lot of general rules in the world, and the market will win here, and sooner or later it will be very massive trends, and we'll see some process, this type of processes now. And I want to say another time that I appreciate very much when Neil said that we must, and Jerry of course and Maritz, that we must trade commodities, and it's necessary part of a trading, and this helped me personally very much, this advices, and because I did not want to trade commodities maybe 2 years ago, and we must trade because Federal Reserve and central banks, Niels said that, can't do something with commodities prices in direct way, can't be influenced in direct way, only indirectly. And when we are talking about financials, central banks can influence on it more effectively in a bad way for us.
Yeah, Richard has talked a lot about this subject and on his blog and his videos and on the podcast. So, and I think one of my takeaways, hopefully I got it right, is that from Richard's point of view, it's the convergent traders who have created a lot of this choppiness and difficulty and staying in the trends. The opposite of the too many trend followers. And then one of the solutions is the longer term systems, which create the bigger drawdowns, which may be a deterrent for too many traders who trade the trends and hunt for the outliers and are going to embrace the drawdowns that come with what the type of systems it's needed in order to stay successful. I think, but then again, over the past many years, we've seen tremendous trends in the stocks and the bonds due to a lack of inflation. So we've got our bases covered with all the sectors, the longs and the shorts, and maybe the inflation or not inflation. Obviously, inflationary periods with long commodities would be a great thing for us, like we've seen recently with the long commodities that hadn't worked for 10 or 15 years. So I think our ability to sort of understand what is long term, what is necessary, how often do we need to see these trends, is put to the test sometimes when we don't see trends in certain sectors and markets for long periods, and yet when we do see them, it kind of makes up for some of the periods where there has been a lack of trends.
I believe it's also like I remember this discussion on Twitter. I believe it's also like a yo-yo effect almost, where you have like a concentration of a lot of convergence or convergent traders at this certain period of time, but maybe because it's a decennia or a longer time, it seems like forever. But then at some point, the mean reverting starts working less because the price starts to jump out. So if we look at the market, if we see the market as a, and this is me just thinking, if we see the market as a whole one, how do I say it, as a whole one product or whole one market, it could be a case of this is the time where it's more mean reverting, converging, or let's say ranging, and there will be a time where there's a breakout of the full market where everything just uh, goes haywire and goes more into the divergent phase. So it could be a case that that period will come at some point where basically in terms of divergence, that will be way more advantageous than now.
I don't think we should disregard what the market's delivered to us in the last year. Look, I've seen these funds, and I'm seeing record profits being produced by these trend following funds over the last year. I'm referring to someone that's sitting here too, Jerry. But it's been a marvellous year, and I just see that getting better.
It's been the best period I've ever seen. I mean, I've traded larger in the past, of course, but I've never seen it this good consistently for this this amount of time. But it hasn't been that much time. It's been concentrated into not a long term period, less than a year. So it's been amazingly fun. But I think all these conversations inevitably, in my mind, get back to this one concept, and that is sample size. We always complain, I think rightfully so, that now that we have to trade longer term, our sample size, the number of trades that we can look at in a back test using all the markets and the longs and the shorts is getting smaller. And we're not happy. Even if we traded shorter term, would we be happy? Not as happy, no, because we want more and more trades and more sample size. So looking at the markets and dicing them up, well, this is how Bitcoin looks, or this is how the currencies look. This is the recent data. These are the emerging markets. This is how those trades look. We're inevitably saying, well, okay, you can do that, but now we have even less sample size. I'm not happy with the amount of sample size I have looking at the past 40 years, looking at every single futures market. Maybe we have to be a little careful. We can't include all the stocks, can we? So we can include some stocks or just the indices possibly in the back test. So that's why I'm very hesitant to embrace. I look at the markets the way everyone else does, and I say, darn, this market or Bitcoin, this sector, yes, it has certain characteristics. And then I slap my hand and say, no, you can't look at that. The big eyesore is the shorts. Golly, why do we have to include those shorts? Why do we even trade these shorts? They're so inferior to the longs. Well, it's because of the sample size, and our expectation is not per sector or per market or for the longs. It's for all of these trades over all of this time period. We cannot say that the last 10 or 15 years has changed, even though we know that the world changes all the time, but not for us. We have to force ourselves to trade all the markets the same, the longs and the shorts the same, and use all of the data. And I've said over the years that if things materially change, if that's a wrong idea, I'll be the last one to know. I'll be the last one to implement it. I'll go out at the bottom because I refused. I could not accept less data and looking at fewer trades.
And with that, Jerry, can I ask a question? I mean, I really apply this question to anyone who wants to answer it. In maintaining consistency, because I think it's fairly difficult to be consistent. I think that's just because I'm still fairly young to the game. But in making an effort to become more consistent, one of the things that I've done fairly well is keep track of my efficiency. And so I think one of the things that's going to keep me, pursuing this with the same level of vigor as I have it now is the fact that I have yet to reach 100% efficiency. And I really enjoy Bruce Kovner's section in Market Wizards because one of the things that he advertises is to make mistakes regularly. And I find myself constantly learning from my mistakes. But at the same time, the goal, having the objective of actually achieving 100% efficiency in I won't say all systems and all markets, because I think that is a bit, that's more of a dream or a vision, I should say. That's a vision. But, achieving 100% efficiency for a summer, that's something that I think is manageable. So my question is how much of a factor does efficiency play in developing long-term consistency?
I don't think I understand what you mean by all of that. So maybe at the next week you can explain what you mean by efficiency. Um, I think that it's perfectly fine. You're not going to get too much, in my mind. Of course, everything can be started with, for all of us, with, in my opinion, or the way I look at it. Of course, is that if you traded as many markets as you could and diversified as much as you possibly could, and you traded a few systems that were breakouts and were fairly long-term breakout systems, and you executed those trades every single day like you should, and only those trades, you're done. I mean, there's nothing left to do. You're efficient. It doesn't look efficient, yeah, because it's not supposed to look efficient. Some of your big profits are turning into losses. Some of your big profits are turning into smaller profits. Yeah, it looks horrible, but you cannot understand anything that anybody has said in this clubhouse, but you're completely ready if you're trading small and using these breakout systems, maybe a couple different systems. So I don't really know what you mean by efficient, making things better, making the results better. It's really not. I have a feeling maybe you're headed down that direction, but I don't think you can look at the performance of these systems that are very lumpy, very choppy, and have lots of volatility and say, oh, let me make this better and more efficient. No, you're headed the wrong direction.
Thank you. You answered my question, because the idea that I was going for is that trader efficiency is how many times I actually take the signal when my system presents it to me. So, or do I execute on a trade that isn't a part of my system? So where those errors and those mistakes impede the overall performance of the system, that would be one of those factors that determine efficiency. If I'm following my system, I'm taking the signal as it's presented to me, then that's me being efficient. Because I cannot. I have no idea how to make a system more efficient. I can only work on I'd say my psychology and in really conforming to the profitability of that system. So you answered my question. Thank you.
I'd like to add for a second. That you executing your system perfectly you should strive for perfection. It's not a dream, and you should try to execute every trade. And the better you get at it, the more you do it. And automation helps here because if you are trading these breakouts, you can remove yourself from that. But as long as you're that human in the stop gap, you are the weakness. And I think you've kind of realized that with the psychology. So you should take every trade your system presents, and you should take absolutely zero trades that are not in your system, and that's it. And you just wake up in the morning and you think that. I think it sounds simple. It's hard, but I think that's how I.
Yeah, in 1983, after a 2-week course, I was supposed to execute the rules consistently all the time, 100%. So what is it about us that we can't do this? And we are the weak link in this situation. Is there a business model out there that says, hey, give me your rules, I will take your rules and your markets, and I'll take you out of the equation and I'll do it for you since you are this weak link? Probably. I mean, are we serious about it, or would we eventually shut that down and change that relationship to where, we'd say, I can't have these people doing my trades consistently, 100% all the time. Well, then what does that say about us? But that's essentially what we all should put ourselves in a situation where we are systematic, we are automated, but we also don't have the ability to override this automation. And if we really believed in systematic trading or our systematic trading and approach and rules, then we would welcome handing this over to a disinterested third party whose only job was to do those trades.
When I think about the market and how it changed in the last decades, what I think is that most of the big money, being pension funds, etc., is not managed by their owners now, but by committees. And I think that changed the dynamic. And I think that maybe trends happen less often, but more violently, because those guys, they don't have any incentive to change. They just keep investing in buy and hold securities most of the time, and in things that make them be more similar to one another. And since they don't have to talk with one owner, because they have millions of owners, they just have more time to until they know they are wrong and change. And I think that's something that maybe changed the market in the past decades.
You know, I remember being taught about these outliers and how important it was, and this is what we were to do, is to get these outlier trades. But then as I started with my own business, I just think it fell away, and I don't think I ever, went into meetings. I mean, I don't know that I've ever heard a trader, a trend following trader other than Richard, say, my whole goal here is to hunt these outliers and trade small. And so I don't think I've ever went into client meetings with big institutions saying, I'm going to have this preoccupation with these outliers, and this is what we're here to do, and this is what the markets, they have this positive convexity or correlation into the data itself has these outliers built into them, and so this was never. It's probably never put to clients this way, so they even haven't even had a chance to reject this whole philosophy.
Yes, this is something that when I remember Niels in a prior podcast was saying, how can we better define trend followers? Is there some way, rather than say using crisis alpha, and the way I tend to think of it is just this refocus towards this notion of these outliers, this non-linearity. Is there some way we can verbalize that better to our clients or to the clients, and get this recognition that is what sets us apart from convergent models? I know all divergent models basically do focus on these outliers, but specifically trend following seems to 100% capitalize on these non-linear events. But it'd be interesting to see if we could flavor the definition of what we are in relation to these outliers.
Yeah, you would think that they would get so sick and tired of hearing the same presentation about diversification and systematic and crisis alpha and equity curve management, vol targeting, that they would say, well, you're crazy. You're sitting here. I'm going to have you in my portfolio. It's going to get these huge positive shocks whenever we have these big outliers. Finally, somebody, by going back to the classic way of trend following, is now offering something very unusual. But in my career, we all got sucked into the latest and greatest way of talking about trend following, which was this crisis alpha, something that's not correlated to the equities, volatility targeting, risk management, other types of strategies combined with the trend following, that we got away from something that's very different by just letting those profits run.
It's very tempting to be converted by crowd talk and to sort of follow the crowd, but we want to set ourselves apart, saying that we are distinctly different. We are not applying the same predictive methodologies as other techniques. There is this absolute return story in our method. Yes, we've got a volatile profile, but volatility does not equal risk, and this is why. And we can certainly define ourselves as being a cut above the rest, as opposed to being just a part of the rest.
And I think if I ran some of these CTA firms that have employed very smart people, and they've tried to mix the trend following with more of a traditional portfolio management and volatility controls, and you said, hey, don't solve for Sharpe any longer. Just make the most amount of money per risk taking per trade I don't know if they would even say that. Then what am I going to do for the rest of my day? If all I'm going to do is try to maximize the return given the risk per trade, and not solve for this thing that's almost unsolvable unless you're willing to make your systems less robust and not focus totally on the outlier trade, then I don't even know if the majority of the industry would even accept that. They instituted these risk control that would give them up to a fun game they play, just trying to preserve your capital and wait for the big outlier.
Yeah, but that's because this is a convergent mindset. These convergent people, they think about diversification as a way to manage their risk. And when they see a trend following equity return, equity curve, they look at it and say, "Oh, this is different. This is a way to diversify my risk." And I believe that we have been exploiting this narrative because it speaks to the heart of these convergent strategies and convergent portfolio managers. But what I'm getting from this talk today is that, and I believe that what's you guys' goal all this time is to find a narrative that plucks us from this convergent mindset.
Um, uh,
All this talk about how do we manage diversification, and how do we look at outliers, and how do we chase them. I think this is gold.
I think in general we all know that we can't avoid risk. We can only minimize it. And I have a business background, and I want to say that trading the markets, properly transforming trading is the safest business we have ever seen. It's real very safe because of money management, because of we can, in fact, we can predict not the events, not their maybe performance, not profit, but we can uh, predict at some level our risk situation, so we can manage the risk in a very good way. We can diversify the markets, which also a part in some way, a part of risk management. So I think that transform trading is the safest business I have ever seen.
I got 2 points to make here regarding the sustainability of trend following strategies over time. Regardless of what those guys said back in the 80s or any books, Market Wizards books or whatever, there has been a very strong trend of professional managers and information flow over the past 30 years, especially with the innovation of the internet and just the progression of the investment management industry. So, we have better tech. We have the best tech we've ever had in history today. And it's just been getting better and better over the past X amount of years and decades now. And also, we have more professional money managers than we've ever had ever as well. And yet, we still have trends. People are able to get information much faster than they ever have. We used to have carrier pigeons and horses, and now we have high-speed internet that travels instantaneously. All of these things that people, again, back in the day, believe that we're going to change the dynamics of the markets, and we're going to take away their edge and things. At least in the long term, just has not happened. there still are sustainable, long-term trends that occur. So maybe that's different on the short-term stuff, especially the high speed HFT type frequencies. But yeah, and now I forget what my second point was.
Mike, didn't
Fuck.
you write a note a while back about how trend following is kind of like a baseball player with a high slugging percentage, where it's not about consistency, it's about basically hitting home runs and striking out a lot, and it's okay to do that? I thought that was a good one. Wasn't that you?
Probably. My life was baseball for 25 years. So probably. Oh wait, I know the second point. Second point, especially I think a good example is the last year and a half. But I've seen this trend. Now that I'm now 37, I came into the business. Started working on Wall Street at Bear Stearns when I was 22, back in '08, and or 23, back in '08, and I think there has been this societal trend change towards risk aversion in general. I think I see it. Now I have a lot of friends with kids now. And we've all heard the helicopter parent, that type of thing. Now there's like a new term called the lawnmower parent, where they just don't want any obstacles for their kids. And I believe this is a societal thing. I don't think it's I don't know if it's specific to America or like the Western world or whatever, but it seems to be happening at funds as well, where there you see like this optimization towards sharp, and they just want no vol. They want this consistent, smooth path upward, and in their P&L. And if there's any hiccups, we have to solve for this. No, no, we can't. We're too smart to allow for this. This isn't right. And I believe that this is very dangerous because it's, I don't know, you can go through periods where it feels like you have figured it out, whereas you're just in between storms type of thing, where you haven't figured it out. You just, a storm hasn't rolled through yet and really tested you, or a new environment hasn't rolled through that you haven't seen before. But now you're really optimized towards the past. You're always fighting the last war type thing. And I believe this is just, it's going to be self-correcting, in the sense that, in terms of investment managers that have previous track records of doing well during all sorts of environments, are just not going to do as well, because they've kind of started to optimize for, sorry, they changed their gears, and they had been more of a robust, all weather type of a player, to where now they're not. Well, now, bring it back to like a baseball analogy. Yeah, I can hit any pitcher anywhere, righty, lefty, any pitch. I'm just like, I'm not the best in the world, but you can put me in anywhere and I can play anywhere. But now it's a little more, they're more tailored. They're just more specific type players, and I think funds and strategies are going this direction as well. And then we see it in the in governments and countries as well now. No, we can't have any pain. There's no pain allowed anymore. Not one more COVID death. We can't allow this. We can't take this. We have to sacrifice everything else to optimize for this. Like, that's the trend. That's the trend I see across the globe and in human beings, especially over the last 15 years. And I imagine it'll only get worse until we have a real major self-correcting event where people learn, like, oh, that was dumb. All right, you know what? We got to be okay with some gyration. We got to be okay with some pain. Pain isn't necessarily bad. It's just life. It's normal. But I think we're going towards that type of an aha type of moment where people learn the error in that endeavor that a lot of people are pursuing now.
So Mike and I had this discussion probably this week, and the one thing that I was adding was that this sort of high bar to improve and evolve and become better and add things to the trend following and smooth out that vol, this is not required of their favorite investment, the stocks and the bonds necessarily. So, oh no, those are core. I mean, it really doesn't even matter how they perform. No, I mean, as of now, I mean, how long will it take to wear out the stocks? How bad do stocks have to perform over the next years in order for stocks to not be the core of every portfolio? Well, we can't even imagine. It probably may never happen. It's stock performance is immune to its own performance. It's going to be a core allocation. But once we start thinking about all these crazy alternatives, regardless of their performance or their volatility and how they actually fit in with the core allocations, well, they have to be held to an incredibly high standard. Are my CTAs evolving? Are you realizing that the markets are changing? Are you using AI and ML and new types of data? On and on. And so I just find it a little humorous that the um, institutional investors are so ill-equipped to, and if they find any reason to allocate a pittance, a small pittance to alternatives or CTAs, it's the largest firms, and certainly those who have never breathed a word in any marketing material, any podcast, or in any meeting that their bottom line is hunting outliers.
But isn't that so? Because the issue is that, the old saying that nobody got fired for buying IBM. If you lose, if you're an institutional investor and you lose 10% of your fund in the S&P, or instead you lose it in a trend following or in an alternative investment, isn't the first much more easy to get after? Sorry, I don't get the word.
Of course, and exactly. Who's your master? In 2008, when your pension holders come to you and say, have you never heard of trend following and diversification and CTAs and shorting and currencies and commodities? They'd say, of course I've heard, but I didn't want to get fired. Well, who was driving your professionalism? Was it were you ignoring what you knew was better for all of us, but you didn't want to get fired? And as long as everyone has the same thoughts and holds all this core portfolio of stocks, then that's what was driving your ethics and your professionalism, and not instituting things that you knew would be temporarily unpopular possible, but was better for me, the pension holder, who was relying upon you to manage all of my money.
Yeah, but the previous decades, there were guys like the guys at Yale that, for example, were pioneers on investing in emerging markets. And that was something that was tolerated at that time. I think that now it's much less tolerated. I think that, the heroes of decades ago were Renaissance and the guys at Goldman Sachs, and now they are BlackRock and Vanguard. So there is such a strong urgency to be like the others. It reminds me, in my country, there was a private pension fund industry, and there was a fine if your fund was very different from most of the others, either up or down. In each month, they will charge you something if you were different. And I think that that was here and it was explicit. I guess implicitly there's something like that in the US and in the rest of the world.
I I think that it's just a misalignment of what is it, benefits, or I can't think of the word right now. Um, but the person running the portfolio for the pension fund has this career risk, but every teacher in the pension fund has retirement risk, and one is actually much more severe than the other, as in you could probably find a new job, but you can't save more in your pension. um, and people are very short-sighted. It has to do with like, if you're only going to be the PM for 10 years, or you're the president for 4 years or something like that. I do think that's why people tend to convergent trading, because they would rather have a steady return stream of 10 years on this junk bond, and then as long as I'm not the manager when it blows up before maturity, it's fine, and just kind of pass off the bag that way, or try to hide the risk. But I want to go to something that Jerry said earlier. Sorry to track back, but um, about the changing things. I've realized through all these conversations here on Clubhouse and finding peak complexity. Uh, how do you deal with that? How are you so strong to know that, like, okay, I want to keep it as simple as possible. I know I can get the clients to sign up for this thing. I can grow a business, not falling prey to the new machine learning or the new trinket or the new phrase, from Crisis Alpha to, hunting outliers, or however. Um, how do you manage that for yourself?
Well, I think you can't. I think you have to make up your mind. Well, I think that people have demonstrated that they can. Yeah. So it's this compromise. It's it's like, we'll give them as much of this new religion as they can handle. But if they need to keep their same traditions, like a missionary going out and for Christianity, saying, "Well, I'll give them as much Jesus as they can handle, but I don't want I'm not going to be able to get rid of all of their own traditions." And so I think it's the same thing. You say, okay, how much trend can we give them? How much outlier and currencies and commodities can we give them? But we don't want to get fired. And they've been very adept, some of these larger firms, at doing that. And that's the reason that they do it. Although I hold out the possibility too that they actually believe it, because they probably all went to the same schools and they have the same mentality that risk equals volatility, or um, yeah, I think basically, and and we can have our cake and eat it too. And but I think for me, I just have always been not willing to do that, and so I have this strong opinion, and for the classic trend following, the pure trend following, and a lot of the concepts we talked about today, that I refuse to compromise on. So whenever I've had lots of money under management, it's just sort of random. Like, oh, you had a good performance, we'll throw money at you, irrespective of you not kowtowing to the way we look at the markets. And then when we had bad performance, we would have redemptions because we were having bad performance. So never have I probably gotten very much buy-in to my philosophy of managing money, and my unwillingness to compromise on the basic principles. And so it's definitely led to a lot of volatility.
I just want to add to what Jerry said, that I completely agree. I mean, I think it's clear now that investors want to buy, the more appealing story, the complexity, and all of the things that were talked about. So I think that's for sure. But I also want to add one thing to the previous topic, which I don't fully understand, and that is how pension funds can argue not to include trend following, given the fact that they have a fiduciary responsibility. What proof, what evidence are they holding on to keep avoiding this asset class? That I don't understand, and I don't understand why they're not being challenged on this, frankly.
I even see that myself, Niels, in relation to when, for instance, I try and find a listing of the top long-term fund managers in the world. There is no such listing. So you've got to compile one yourself through whatever sources you can get. So you might be able to go to Greg Zuckerman's book and find, a list of maybe 10 of them. I don't know where he sourced them. But then I see that there's a whole class missing, which are these trend followers, and there's 30 of them within that listing of 10. So, it's a problem of the entire industry. We are hidden under the rug, or they refuse to believe that we exist. I agree with you. There should be a fiduciary responsibility for them to consider us. So I don't understand.
And since you're not going to get any better than the last year and a half of the benefits of buying and selling the breakouts. And we saw it in March, February of last year. Just get flat to short as quickly as possible. That's what won the day. I mean, it didn't necessarily have to be incredibly short term, but turn those trades around. Everything is going to go short. And then what happens with the commodities? Just trade the stupid commodities. Just trade a lot of commodities. Hit the breakouts and don't do anything. There's nothing to do in any of these trades hardly. Just hang on to that trend. So it's not going to get better to see the differences between the more classic trend following and the trend following or money management of the larger CTAs. And so they've underperformed, definitely risk adjusted. And since most of them trade smaller, absolutely they've underperformed. the any type of non-trend following is going to probably diminish the returns as well. The larger ones can't trade as many commodities, but it hasn't had any impact on their AUM other than probably to increase their AUM. So what is, once again, if you do it the correct way, if you do it the right way and market it the correct way, you can actually underperform, but get the benefit of, commodities have gone up. We've had some positive returns. So there is no way to, at this point in time, to actually be rewarded in AUM terms for the great performance we've seen in a more traditional commodity-centric breakout style of trend following.
Guys, I'm getting to the end of this recording. I've been recording this episode, but we're in about 2 hours 45, and my hard disk space is rapidly drying up now, so I might have to stop the recording soon. Just thought I'd better let you know.
I listen to a lot of, obviously a lot of podcasts and a lot of webinars, and they're out there all the time, and they're so boring, except for Niels, right? Or maybe a handful of other ones, right? Who get down to the nitty gritty and talk about the trading. I mean, I would just love to see like a CTA with not a lot of money, talk to people who allocate money in some of these webinars or podcasts. Like, what is the problem? What is going on here? What are you thinking? What's wrong with hunting for the outliers? And I used to go into a lot of meetings and just say to people, look, I can see your portfolio of CTAs. They all vol target. None of them trade 50% commodities. You got to add me just because I'm different. It's kind of funny. I'm going to sign off as well, along with Richard's recording device, and I can keep the room going. And so that's what I'll do. So if everybody wants to stay on, or anybody wants to stay on, it'll keep going. But I'm never exactly sure how to end these things. But this has been a
We could get a
record-setting
drum roll.
Exactly. This has been a record-setting one in terms of time and quality. And I didn't speak for the first 45 minutes or an hour, but I certainly made up for it in the next hour and 45 minutes. So I thank everyone. It's been fun, and we'll do it again as usual next week. Thank you.
Thanks, Jerry. Take care. Take
Thanks,
care,
Jerry.
everyone.
Bye, everyone. Bye,
Thanks,
Niels.
everybody.
Bye, guys.